Little lesser known quote from Buffett. I know people like to quote Buffett, but one of my favorites. What is arcane accounting math? Where do we see it? I've shown a couple of companies. You see it in the entire S&P 500. The entire S&P 500. So this is quarterly. This is right out of Bloomberg. S&P 500 earnings going back to 1988. Going back to 1988. Now, you tell me, are earnings getting more stable or more volatile? Well, take a look at this. This last period, this 2009, this is what they call the big bath. The rules of accounting allow companies, perfectly legal, to say it's going to be a bad year, so you know what? Let's write off everything. Make it a really bad year, because we're going to write off 2009 anyway, literally write off everything we possibly can. Write off stuff that we've done bad for the last 5 years, and write off anything we think will do bad for the next 2 or 3. This is allowed. So if you think you're going to have to fire people in 2 years, take the charge for the severance in 2009. When you spend the severance in 2011, it doesn't show up in the income statement. So what happens? 2009 looks a lot worse. Now, is the market fooled? I don't think so. I think the market said, okay, we're going to fall 40%. That's painful, but it didn't fall 95%, the amount that earnings fell, right? The earnings numbers are getting worse. They're not getting better from all these new accounting rules and complexity. And this is not just US, this is internationally. So, I mean, a simple, I'm being pedantic. If you take a price to earnings ratio, right, and the P falls by 40%, which it did, and the E falsely falls by 95%, which it did, what happens to the PE ratio? It skyrockets. It skyrockets. So what happens in the journalists, and this is actually in the Wall Street Journal. I remember in the Wall Street Journal, after the S&P hit 666, that scary 666, right, in 2009, a journal article came out, and it said, you know what, the market could still fall another 50%. And they said, why? Because the PE in 2009 has skyrocketed. That's out of Bloomberg. Actual data. This is real data. They're saying, this is because the earnings number is bad. This isn't because the market wasn't cheap. The market was the cheapest. The PE ratio, because the E is so bad, is giving you the worst possible signal at exactly when we should have all been buying the stock market. PEs were showing the highest levels in 30 years. As reported PEs. As reported PEs were showing that. Now take this to today. So this is the Cape. We stand on the shoulders of giants. So Robert Shiller, Nobel Prize winner, called the real estate market bubble, has been using this. He even said, by the way, don't put too much stock into this, but CNBC and a whole bunch of other places have been publishing this and saying, look at this 120-year chart of PE ratios, and this 28 times is the third highest we've ever seen it. So it must be we're in a bubble. This is 2 years ago, by the way. They said we're in a bubble because of this. Here's the problem. If the E is being calculated differently, which it is, today versus 5 years ago or 15 years ago, the P is the P. I have no complaint about the price. The price is the price. But if the earnings number is being calculated differently over this kind of time, of course we're going to get bad signals. Of course this is going to tell us to buy when we shouldn't or to sell when we shouldn't, and that's exactly what these numbers are doing. So what I'll show you is, in a second now, is uniform accounting. So uniform accounting says we don't let one company be on LIFO, pricing their inventory as of today, and another company be on FIFO, pricing the inventory as of 8 years ago. We put everybody in the same accounting. We take the companies that are renting. We say everybody gets capitalized leases. We treat the renting policy exactly the same. We don't allow one company to put interest expense as operations and another company put interest expense under financing. We put everybody's interest expense under financing. If we do all these adjustments, here's what we see for 2,500 companies in the US. The highest earnings power corporate profitability that we've measured since 1950. Since 1950. This is the strongest earnings power corporate America we've ever measured. We've ever measured, all right? That's what the signal is telling us. And 2018, I'm not going to put a lot of stock in the estimate, but 2017 is already based on 2 quarters. That's a decent number for 2017 for a forecast. And it's saying it's rising even beyond where we've seen. Now, if we have a clean earnings number over the course of 20, 30 years, let's take the P and divide it by the earnings number, and what do you get? 18.5, below average of the last 20 years. So I heard Steve Sugarroot's presentation, and these signals, while orthogonal, Ms. Jameson, orthogonal in nature, are totally in line in terms of the result. That this is a very healthy stock market. It is a buy the dips market because nothing is telling us that this is going to fall. And in fact, I'd even say the market's a little cheap at this point. Not just reasonably priced, but a little cheap relative to this fantastic earnings power as measured by return on assets, which is just clean earnings divided by a clean asset number. Clean meaning uniform for all companies in terms of accounting.